Choosing the appropriate ETFs to invest in might be the difference between becoming a billionaire and watching your wealth disappear. Now, there are already more than 8,500 ETFs trading on stock market, so you may be putting your money into the wrong ETFs. And this video covers something unique about ETF investment that you won't find anywhere else. Unless you know it, it may hurt your long-term investment results. You see, ETF combines the advantages of both index funds and individual equities. So, the benefit of trading individual stock is that transaction may be made at any time of the day. Therefore, they are particularly liquid investments since they may be sold whenever the stock market opens. Now, you can rapidly liquidate your stock holdings if you are in a time crunch. However, stock's lack of diversification is a major drawback. Suppose you have only one stock in your whole portfolio. The risk here is that the company's stock performance will directly impact your portfolio's performance. Basically, index funds are a simplified and handy way to invest in hundreds or even thousands of different equities. Furthermore, this means that their investment portfolios are incredibly diverse. On the other hand, index funds are not highly liquid assets because they're only exchanged once daily at market close, unlike individual equities. Unfortunately, you can only obtain access to your money invested in index funds at the end of the business day, and this may be a problem if you never need to sell your investments immediately. ETFs combines the greatest features of index fund and individual equities into a single investment vehicle. You see, like stocks, ETFs are exchanged on the stock exchange. As long as the stock market is open, you can buy and sell shares anytime. But now the question is, how do you determine which exchange-traded funds to buy? Before we go into what to look for in an ETF, let's discuss a few other things. The issuer of the ETFs comes first, since they are the entity responsible for creating the ETF. Surely you're familiar with such storied investment firms as Vanguard, Invesco, and Charles Schwab. In total, over 200 ETF issuers give people like you and me a chance to diversify our portfolio with ETFs. But not every ETF service is created equal. As a matter of fact, investing in exchange-traded funds from the wrong source can have a major effects on your returns. For this reason, it is important to research the ETF provider thoroughly to ensure that they are financially sound and technologically advanced enough to maintain low fees and proper risk management for their ETFs. Now, one feature of an exchange-traded fund that can't be ignored is the expense ratio, and the annual cost of owning the ETF is expressed as an expense ratio. The funds are used for things like fund management and marketing. In addition, a fund's expense ratio is expressed as a percentage of the total amount invested. For example, if the expense ratio of an exchange-traded fund is 0.0% and your investment amount is $1,000, you will pay $4 in annual fees. Also, remember that this payment is not like a subscription in which the firm automatically deducts funds from your bank account to cover the cost of the ETF. Instead, the money is deducted from your account as fees. The expense ratio of an exchange-traded fund is crucial because it may eat up hundreds of thousands of dollars throughout an investment's lifespan if it is too high. Therefore, you should put your money into exchange-traded funds with a low expense ratio. Now, before we continue, I'd like to thank you for getting this far. And if you want to know more about ETFs, then make sure to stick till the end. The dividend yield of the ETF is the next consideration. Now, dividends are fantastic if you invest with a tax benefit account like Roth IRA or 401k. It's because your dividends will be saved from federal taxation with these accounts, especially with the Roth IRA. However, dividends are taxed when distributed from a regular brokerage account that does not offer tax advantages. The tax you pay on dividends depends on whether they are eligible or not qualified, and dividends that meet the criteria are treated as long-term capital gains for the tax purposes. But depending on your regular income tax bracket, this means you might wind up owing 0, 15, or 20% in taxes on your profits. It is important to note that dividends not qualify for special tax treatment are always taxed as regular income. Therefore, the amount of tax you must pay on such dividends is based on your tax rate. Now, if the ETF pays higher dividend, these taxes will eventually eat away at your investment returns. The ETF's total assets under management should be your next consideration. For example, if a particular ETF has a total of $1 million in assets under management, it is because 100 investors have put in total of $1 million. Now, generally speaking, an ETF is better off the more money it manages. It's a sign that more individuals are willing to put money into the ETF, and it also suggests that the ETF will be more liquid. Now, buying and selling on the stock market are simplified due to its development. The turnover rate is an additional factor when thinking about ETFs, and the turnover rate quantifies the frequency with such a fund trades its holdings. It is common practice for ETFs with a high turnover rate to pay more capital gain taxes, fees, commissions, and other expenditures. The costs are deducted from the fund's holdings, which ultimately impacts you. Furthermore, some actively managed ETFs and mutual funds include fund managers who would trade equities aggressively to raise their own compensation. This is a very dubious business that you should avoid at all costs, and if the ETF's turnover rate is more than 20 to 30%, you should be suspicious of it and not invest in it. Now, the underlying index is that last factor to consider when investing in ETFs. So when deciding which ETFs to invest in, most investors focus solely on the fee ratio, AUM, and funds issuer. There's no doubt that each of these factors is crucial. Still, there is something that is overlooked by the vast majority. The index and those weights are what the ETF is tracking to achieve its investment objective. Now, one of the most outstanding exchange-traded funds to put money into is the Vanguard S&P 500 ETF, VOO. The S&P 500, one of the most widely followed benchmarks, serves as its underlying index. Moreover, it monitors the progress of the 500 largest companies in the United States. Now, the Vanguard Total Stock Market ETF, VTI, is the top exchange-traded fund ETF option. This exchange-traded fund invests in all 4,000 plus companies listed on the New York Stock Exchange, thereby covering the entire US stock market. So, if you invest in this exchange-traded fund, your portfolio will immediately gain exposure to the US stock market. Then, add the QQM or the Invesco Nasdaq 100 ETF to your portfolio to increase its weight in the technology industry. This ETF tracks the Nasdaq 100 index, a tech-heavy stock market index that includes more than half of the non-financial technology companies. You can also buy the SCHD or the Schwab US Dividend Equity ETF. Now, if you're looking for a straightforward to invest in the market, exchange-traded funds like VTI, VOO, and VT are your best bet. Each of these ETFs will provide you with diversified exposure to the US market, while VT will do the same for the foreign stock market. These exchange-traded funds are excellent choices for putting your money in dividend stocks. Now, before investing in ETFs, make sure to do more research aside from this video. In addition, make sure to consult a financial advisor if you need one. So, what do you think of ETFs? Let me know what your thoughts in the comment section below. And while you're at it, make sure to smash the like and subscribe buttons as well. Now, if you want to know more ETFs, then make sure to click and watch this video right here and enjoy. And that's the end of this video, guys. See you next time.